Uh, if it's true that one of the triggers, at least, of this crazy week had to do with the 10-year yield spiking at one point, twice, yesterday and Monday, to 2.88%. Today, we do have it moderating just a bit. It is slightly lower off those levels, but you got to ask yourself, which sector would supposedly benefit most from that trend of higher rates? It would be what? The financials and the banks and the brokerages. So why are they collectively down 8% this week? And what does that foretell for any of us or any of you out there who want to own them or were thinking of buying them? Famed Wall Street banking analyst Dick Bove of the Vertical Group has a very pointed answer to that. All right, Dick, why would the very group that's supposed to move higher as rates move higher drop that much this week?
Well, first off, because rates moving higher are not necessarily positive for that group. In other words, you've seen over the past, from when the Fed started hiking rates in the third quarter of 2015, the Fed funds rate is up, about 132 points, right? Basically, yeah. If you look at the top 8 banks in the United States, 3 of them have either down net interest margins or flat net interest margins. Not one of the other 5, which showed an improvement in net interest margins, got as much as 1/3 of the increase of the federal funds rate. So in other words, when people look at banks, they say, gee, interest rates are going up, and therefore the banks are going to charge more for what they're selling. But they don't stop and say, well, wait a minute, it's going to cost them more money for what their raw material is, i.e. the money they take in. And secondly, they may not increase the interest rates on what they're selling.
Right,
and they didn't. So the net effect is the margins got squeezed. So the increase in interest rates, that people say automatically means higher bank profits, do not automatically mean higher bank profits.
Would you buy them here? They're on sale,
No.
Dick. And if so, you would not?
No. In other words, we're dealing with a significant change in the structure of the financial system in the United States, right? For the last 8 years, since 2010, we were in a financial crisis. And because we were in a financial crisis, the Federal Reserve, the government, the foreigners, etc., everybody was subsidizing the flow of funds. They were printing money like crazy, and they were driving the cost of that money to below the rate of inflation, negative real interest rates. The financial crisis is over. They're not going to pump money anymore. They're not going to keep interest rates below the cost of inflation.
Well,
so the net effect is...
I was only going to say, what about companies in the financial space that should benefit from increased volatility or increased trading? The CME gets a commission on every volatility trade out there, doesn't it? Or what about the Charles Schwabs of the world or the TD Ameritrades, which have certainly seen activity going up? Fidelity.
Yeah, you got me on those because I don't follow them. But if you're looking at the Morgan Stanleys of the world or the Goldman Sachses or the JP Morgans, they have an inventory cost, and as interest rates go up, the value of that inventory goes down. So yeah, they get a benefit because there are more trades going through the pipe, but the fact is that the cost of the inventory that they have is going down, so that they're not seeing a big increase in earnings as a result of the increase in volatility in the market. Mm-hmm. In other words, bottom line, if you want to make money in banks or financial companies, it's because they're selling more of something. And the something that they sell are loans. And if they don't sell more loans, they're not going to show an increase in earnings, and their stocks are not going to do well. And so far, they're not selling a heck of a lot more loans.
We have a very long bull market. It is now in its 9th year. Growing a little gray around the temples, Dick, or do you think that the bull case is still in place, bull or bear?
Well, it depends upon, if you're looking at the economy, I think the economy looks terrific. I think
we know the economy is totally separate from the stock market.
Exactly right.
Great, right?
Yeah, you're exactly right. You're right on the mark. The issue is money going to be there to fund the deficit, to fund the growth in the economy, to fund the recovery in Europe? And the likelihood is that it won't be. The net result is there's going to have to be much higher rates, and that's going to result in difficulty in pricing financial assets.
I know it won't surprise you, Dick, but while we were talking, the Dow went from being up slightly to down 100 points. Right now we're down 49. I have to say, it's been a wild week, certainly. I haven't been in the business as long as you. Have you ever seen anything like this? In this specific prism, through this prism of wild trades within seconds of each other?
Yeah, well, what seems to me is happening is that each time the buyers come in and see value and start to acquire shares, the sellers wait until the market gets up a little bit and then it hits them. And then if you take a look at you would know this better than anybody, if you look at the last 15 minutes of trading, you can see what happens the whole day, right?
Yeah.
In other words, people wait until that last 15 minutes, in fact, even to the last minute, and that's when they dump stocks if someone else has pushed the prices up a little bit.
Yeah.
So the volatility is a function of the fact that the buyers see the economy doing well, interest rates being low, inflation under control, and they want to buy stock. The sellers just want out.
Dick Bove, yeah, tell Varney that. Last 15 minutes is the whole day. We're always joking with each other. No, it's my hour. No, it's your hour. Dick, great to see you. Have a good weekend. Thank you so much.